What's up, everybody? Welcome to the April 27th, 2026 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by Indy Wealth. Today, we're going to get right into those hot button issues. So let's get started. Let's start here. Number one, semis, yes, software, no. So I did a little work. If you've watched the market at all recently, you know that semiconductor stocks have been working very, very, very well. What you may not know, maybe you do, maybe you don't, is that software has not worked nearly as well. So just threw a little numbers together here this morning. So the ETF SMH, which is the semiconductor ETF, is up 138% over the last year. That's pretty darn good. The market itself is up 31%. Now that surprised me a little bit. I didn't think it was up that strong. So it has significantly outperformed the market. But at the same time, software stocks, if you look at the ticker IGV, which is a software ETF, that is actually down 10%. So just a massive differential between semiconductors and software companies. And this is the market clearly telling us who are the winners and losers right now. Potentially for the foreseeable future, is that semiconductors, necessary components for artificial intelligence. It is expanding outward now. First off, it was NVIDIA, AMD, Broadcom. Now we're starting to see and then the memory companies came up, and now we're even starting to see it in just broad analog stuff. So across the board, semiconductor demand just continues to be very aggressive, and people are bidding up these stocks to valuations that, some of the stocks valuations actually aren't that aggressive. Some of them are getting pretty high at this point now, but semiconductors in and of themselves have been largely cyclical businesses in history and never have been rewarded. Some have been rewarded with bigger multiples, some not. But usually tends to be people get nervous when, at the top of the cycles, and then they get, start to get bullish when they feel like it's a bottom, that kind of stuff. We're not seeing as much of that now. And I think it's the demand of artificial intelligence is just so broad. They're saying, hey, they just need chips to keep this thing going and to keep this thing building out. On the other side of that is the software argument. We saw IBM had a really rough week. We saw ServiceNow had a really rough week last week. These companies are at the precipice of people thinking that these are the most disrupted businesses, or at least among the most disrupted businesses by artificial intelligence, is that we can bypass software, right? Is that we don't have to build it. We can have artificial intelligence build it for us, and then we just have a conversation with AI rather than buying these bulky software things, a lot of which we don't use or don't even know how to use. And I think there is some validity to the argument. I am a little concerned that we're overdoing that a little bit. I think there are still some very, very valuable players in software space that actually will benefit from artificial intelligence deployment over longer periods of time. And right now we seem to be tossing a lot of the companies out and just saying the broad group is going to be exposed to this rather than being somewhat selective in there. Now, again, software multiples a year ago were significantly higher than where they are right now. I think that's what you're seeing overall, is that people are saying, well, even if some of these companies are going to end up more valuable right now, I just don't want to pay the multiple I was paying before. There's a much bigger risk to their companies than, frankly, probably has ever been since they kind of came into fruition. That the existential risk is a real problem here, and I'm just not going to pay as much as before. That makes sense. I think at some point we do start to see reversion in both. I mean, the spread has just gone so wide. I don't know if it's near term. It could be, still a year or two down the road before we actually see that, depending on what happens. You'll actually hear more about that this coming week. But depending on that, I do think we do see some reversion here. And I think you can be a little bit opportunistic in software and saying some of these companies have just been completely thrown out, and we believe that they're going to be more valuable down the road. Turning to number two, some prominent layoffs recently. And again, this also falls under the theme of artificial intelligence, because the ones I'm going to call out, Microsoft just had a buyout announcement. Meta had a very large layoff. Oracle had a very large layoff, and Amazon has had a very large layoff. The other one that was probably large in 2026, right at the beginning, was UPS. So we are seeing some evidence that at least these companies, with the exception of UPS, and even UPS will be affected by artificial intelligence, but the other ones I mentioned were at the forefront of it, are starting to transition away from people. They've gone from saying low hire, low fire to fire. Then layoffs are letting people go. So it's interesting, and it will be interesting to see how this plays out. There's been some draconian elements of people out there saying 20% unemployment from artificial intelligence. I have a really, really hard time with that, just simply because that disrupts basically everything that we do on the planet. As United States consumers, as workers, um, I think there will be some intervention component that has to come as a result of this, but we're nowhere near that at this point right now. What we are at is people taking and businesses taking very hard looks on how much people they need versus how much productivity they can get off their existing people that they have right now. And I think we're going to continue to see this for a while here, which is again leads into, we've talked about it on our monthly update calls many times, is that we just don't see a big catalyst to job growth, just a broad number of job growth. We might see some wage growth as demand jobs kind of continue to come up. In fact, we are seeing a little bit of evidence of that now. But I don't know if we're going to see the level of robust, just general job force demand that we have experienced in the past. This malaise of, slight growth to maybe even slight decline might be with us for a while. And if the economy starts to sour further, then that number could get worse. So that's something we're going to pay a ton of attention to. Prominent layoff numbers. A lot of times people overlook it, the big ticket item layoffs, if you will, as relaying to a general trend. Sometimes it does, sometimes it doesn't. But that's what we will be paying attention to, is where are we seeing these prominent layoffs and how aggressive are they being? And is it accelerating, or is it just a few one-offs? Right now, I would call it, at least in the tech space, there might be some fire with that smoke. I have not seen it relay outward aggressively as of yet, but that's what we will be watching for. Number 3, we get a big tech earnings this week. 5 of the Mag 7. I always call them tech. They were all kind of born in tech, so they're technology companies to me. But it's everybody but NVIDIA and Tesla. So you got Apple, you've got Amazon, you've got Google, you've got Meta, and you've got Microsoft all reporting this week. So as I said before about software especially, and just the artificial intelligence deployment and job components of that, we're going to learn a lot more this week. So be paying close attention to what those companies are reporting. Again, the numbers are important because these are big, big, big companies for the S&P 500. But I don't think there's a lot of consternation or a lot of concern that we're going to see a real cascading number downward. I think the bigger concerns and the bigger issues, the bigger positives and negatives, will be what their growth rate looks like. Absolutely. There's no question. And their guidance will absolutely no question. But within the commentary, I think capital expenditures on artificial intelligence deployment will be paid aggressive attention to. And then secondarily, especially with Meta and Microsoft and Oracle announcing these layoffs, what the jobs number looks like, what they're doing from their employment perspective, and seeing how that relays into what their earnings growth looks like going forward. So I think people will be paying attention to a lot of the commentary, but also, again, these are very large companies, so they have a pretty big impact on the overall S&P 500 earnings number too. Turning to the personal side, number 4, we have my wife and I have been watching the show Rooster with Steve Carell. It's on HBO. Hilarious. If you haven't watched it yet, I recommend giving it a shot. But the thing I really wanted to talk about here was more the reverse aging side of Steve Carell, who looks younger and better now than he did in The Office 20 plus years ago. I don't know how he's doing it. I don't know what he's doing, but whatever he's doing, I want to do more of. So Steve Carell, congratulations. You look younger now. I was amazed. He is over 60 years old at this point right now. He does not look it. But he's very interesting and he's very funny, and the show is worth a watch. So if you're not watching Rooster yet, give it a whirl. That's all we have this week. Tune in next week where we'll have our next hot button topics. But until then, thank you very much. Take care.